is the biggest news of all. Please pay attention. Signals of change so big in the global economy. But I see something not so good, and this is global again, not US. They cannot stop what's about to happen, and nobody's talking about it. That's a huge problem. The biggest news of all is not Trump or Biden or COVID. It's Warren Buffett dumping bank stocks and dumping airline stocks. Can you imagine that? And the question is, what does that really mean? We're going down. We have three options. Either we tighten our belts and produce, go to hyperinflation, or go to war. And I think we're already at war.
How do you get out of that mess? Well, you can tighten the belt. We most likely won't do that. You can inflate away the debt. You've got two choices, and that's you can either be prepared or you're going to be a victim. It's much better for people to control their own finances if they know what they're doing. And right now, I think more than any time in maybe history or American history, by looking at what Buffett is doing, I think it's important for the average person to understand the concept. So, okay, first and foremost, he's selling banks.
The reason he's dumping banks is people can't pay back the loans anyway. That's a huge problem.
So you could say there's a lot of downside risk with loans, especially commercial loans right now, with what's going on with the virus. But you could also say if the Fed decides to peg the yield curve, so that means they won't allow interest rates to go up, even though the rate of inflation is going up, then that really hurts the banks because they're getting paid back with these cheaper dollars. They can raise interest rates, but there's substantial risk that, let's say, there for inflation. So that's not good for the banks. And then you say, okay, well, what's cheap right now? Buffett always likes to buy what's cheap. And if you look at commodities going back 120 years to 1900, and commodities relative to financial assets, more specifically the stock market, are at 120-year lows. So if you're a value investor and you're buying a hard asset that's a hedge against that inflation, that currently right now, especially relative to M2 money supply, which we can get into later, is extremely cheap. Well, I think he's dumping airline stocks because they're going to have a lot of pressure. When I flew, the flight was maybe a quarter full. And if you're an airline, as you guys know, the margins are incredibly thin. They don't make much per flight. Only maybe a couple seats provide the profit, maybe 3 or 4 seats. It's just that they have so much volume, and that's where they make the money. So if you've got all these flights going around that are half empty, I mean, you got real problems. So I think he's seeing long term, if the governments continue with these lockdowns and these draconian measures, that's going to be very, very bad for airlines. The United States has 26 trillion in debt, but what most people don't realize is going back to 2000, let's call it from 1776 to 2000, the United States racked up about 5 trillion in debt total. And in the last 20 years, we've tacked on an extra 20 trillion or 20 plus trillion. How do you get out of that mess? Well, you can tighten the belt, and we most likely won't do that. You can inflate away the debt.
And George, when you say tighten the belt, you're talking, they call it austerity.
If you look at that debt, is the fact that we've overconsumed. And basically that's what debt is. You're just pulling consumption from the future into the present. So we've overconsumed as a country for literally decades. And so at some point in time, the only way that you can meet an equilibrium point is if you underconsume by the same amount or more that you overconsumed. The additional debt that the federal government is adding to their balance sheet that we, the taxpayers, are responsible for in just 1 year is over $4 trillion. Now, to give you some context, going back to from 1776 all the way to, call it 1990 or in the mid 90s, that we racked up 4 trillion in debt in total. So you say, okay, we went 200 plus years and racked up 4 trillion in debt, and now we're doing that in just 1 year. In just 1 year, we're adding that much debt. So that does not end well. And what has to happen is the Fed has to monetize that debt because there are not enough private buyers out there to buy the amount of treasuries that the government is issuing. So when most people think of quote unquote printing money, they think of the Fed just creating bank reserves. That's when the Fed creates, I call it funny money. It's just out of thin air. It's just digits in a computer. And they use those digits or those new currency units to buy treasuries from the banking system, from the primary dealer banks. That's typically what we call quantitative easing. And most people would call that money printing. But the key there that most people don't understand, those bank reserves really aren't legal tender. So you've got two types of money supply. You have base money, which is the bank reserves held at the Fed, and you have broad money. That's the amount of currency units that are circulating within the economy. You see, so when most people think about deflation or inflation, they're talking about the amount of broad money in the economy that's chasing X number of goods and services. You see, but that doesn't necessarily, there's not a causal effect necessarily with the amount of base money and broad money. What has to happen is the commercial banking system is the transfer mechanism. And what I mean by that is the Fed could create, let's say, $1 quadrillion in bank reserves, and it might not create price inflation in the real economy. Most likely create financial asset inflation, but not, your grocery bill might not go up. But what happens is the commercial banking system, that increases the capacity they have to create more loans in the future. And if they create more loans, then that increases what they call M2 or broad money. And that could create consumer price inflation, because then you have more currency units that are chasing the same amount of goods and services, if not a lower amount. So for the average viewer, the person that's watching this or listening to this right now, what this all means is right now the Fed is starting to create broad money. They're starting to create more currency units.
Will it fix the problem? You cannot print money when the real answer is we have to produce. What does Buffett see?
He sees money printing, and excess money is the only way out, therefore buy gold. When gold goes up, gold miners go up a lot more.
Right.
And when gold goes down, gold miners go down a lot more.
What do you mean by that?
Let's say gold goes up by 10%. Or let's say it goes up by 100%. It's at maybe 2,000 right now. Let's say it goes up to $4,000. So it goes up by 100%. If that were to happen, most likely the gold miners would not go up by 100%. They'd go up by 400%.
There's more
They'd go up
leverage
by
in it.
1,000%.
Yeah, there's more leverage in gold miners.
That's right. That's right. So you have to look at Buffett not only buying gold, going long gold, let's say, but he also is going long gold with leverage. And I'd also like to point out, you said about 560 million, but that's all we know of. And he's not going to buy at one time because he's going to move the market. So since then, Robert, he could have bought a lot more that we just don't know about yet, that we'll find out in the future.